Les Coleman. Warm welcome to the Deeponomics podcast.
Thanks very much. It's a pleasure
So
to be
happy.
halfway around the world and with you.
Yes, and good afternoon, I guess would be correct.
Yeah, so it's late afternoon for me, midwinter. I'm looking out on a very cold, bleak afternoon. You can actually see I'm rugged up. So
Yeah, and it's definitely the opposite over here. So it's early morning and in the middle of the summer. So happy to have you on for this conversation. I came across your work, as I mentioned briefly, when I read your 2014 article, Why Finance Theory Fails to Survive Contact with the Real World. And after that one, I bought your book, Principles of Equity Investment, then your book, Research in Crisis, and also your book, Applied Investment Theory. So I haven't read them from cover to cover, all of them, but definitely focused on the Research in Crisis and the new Principles of Equity Investment, where you present a new paradigm for equity investment, which is really interesting, and we will most likely touch upon that. But I thought for today's conversation, I would like to focus on the topic of research in crisis and perhaps a bit in relation to finance, because obviously that's sort of my area. And I thought we could start off with mentioning how you evaluate a theory, and correct me if I got this wrong, but you evaluate a theory based on its ability to explain the world around us and its ability to make meaningful predictions. Is that a correct way to see it?
yeah, I'll give you a bit of a thumbnail sketch and you can put it in context. But I come from a corporate background. So I spent 30 years working in industry, first of all in Africa in the copper mines there, and then came back and joined Mobil Oil and worked for 20 odd years around the world. So I have a very strong corporate background. And to be honest, my hobby has always been research. So I had the chance to restructure my life and try to get a job at university, couldn't get it, and I had to get a PhD. So the thing that had really interested me through my career was the idea of risk, not so much finance risk, but sort of loss risk, falling over, losing $20, not varying up and down. So that was what my PhD was on, why companies and managers take risks. And then I started teaching finance, and I realized that, to my embarrassment, what we were teaching at university was quite different to what I'd used in the biggest companies in the world. So I thought the fault was on my side, and I set out sort of almost consciously to apply the scientific method to essentially the price of a share. So I went out and did research, and that was the first paper you read, the why finance theory fails to survive contact with the real world. And I interviewed about 30 or 40 fund managers in interesting places like Istanbul and London and New York, which I really enjoyed.
Yeah.
And I had a sabbatical in Amsterdam, not too far from you, and talked to a lot of people there too. And they told me what they actually did. So I put that in one book, and it's called The Lunacy of Modern Finance Theory and Practice. And then I sat down and I went back through my notes and looked at what they actually did. So they told me, first of all, why they didn't like theory, and then they explained to me what they did. And that was what I thought of mentally as a sort of theory of applied finance, how fund managers, and these were all fund managers, except for a couple of really interesting ring-ins. I talked to a lawyer and a public relations guy who gave me different slants on the same thing. And then I wrote the third one, which is a theory book. And having come to the end of that, I was still teaching finance, but I realized that nobody could predict a stable price of a stock. So sure, you can value a stock today, but you come into work tomorrow and it'll be 1, 5, 10, 20% different. So you really can't work out the permanent stock. Markets aren't in equilibrium. What are you going to do? And that's what research in crisis was. I took the problems I'd found with finance, that we didn't have a good theory to explain why a share or an ounce of gold or anything else had the price it had. We had no way of forecasting it. We couldn't say what was going to happen tomorrow, much less in 10 years' time. And yet we were wandering around the university explaining to undergraduates exactly what they should do. It's sort of like never having played soccer or football and then telling a sort of FIFA team how they should be playing the game.
Right.
And I was sort of left in a bit of a spot. So that was the background to it all. And I haven't made myself popular in all quarters, which But there's a lot of people who are really interested in what I've got to say, but would rather not sit beside me on the tram going home from work. So, well, it's an interesting life.
Yeah, you've definitely taken I guess, a risk and a contrarian stance, both in sort of your way of trying to come up with the new finance paradigm, but also definitely in the, sort of going against how even research is being produced today, and that you say that we are in a era of inexpertise, and that is no discipline can explain more than 5 to 10% of what we see. And that's to read that, it's a bit shocking if you haven't thought about this as well as obviously you have. So for me, it's just, wow, is that really the case? And so why do you think that is? Despite centuries of research, we cannot explain more than 5 to 10%. And also, how did you come to that number, the specific 5 to 10%?
It's really keyed off the 5% of dark matter in physics. So, if you take Newtonian gravity, what Albert Einstein came up with over a century ago with general relativity, and then you try and explain the movement of the stars, particularly the acceleration of distant galaxies, and you have to come up with about 90 or 95% of matter that you can't observe, which is called dark matter and dark energy, to explain why the universe looks the way it is. So we can explain 5%, particularly 5% close to us. So scientists can do a brilliant job of explaining Mercury and Earth's movements around the sun. But the further away you get, the more difficult it becomes. And really they're left with this sort of, the universe is made up of 90 to 95% dark matter or dark fluid. So that's the 5 or 10%. And I sort of looked around and used a bit of license, but my background is in geology. And I know for a fact that geologists can't explain ore body formation and where they come from. For the last 50 or 100 years, there have been earthquake and volcano predicting services around the world, and huge trillions of dollars that's been spent in Japan, which has got a major problem there. They can't forecast earthquakes and volcanoes. Tropical cyclones are another thing. So we know some of the most damaging natural events we simply have very little understanding of. And then you look at medicine, and I'm sort of getting a bit of an age where some of my mates are getting sick, and they go to the doctor, and the doctor says, well, look, I'm not really sure what's going to happen. It's about a 1/3 chance you'll get better, and 1/3 chance you'll stay the same, and 1/3 chance you'll get worse. And which group am I in, doctor? I just wish I could tell you. So the 5%, 10%, it's not a accurately calibrated thing. It is a bit weak, and there are some areas that do better than that. But really, I've challenged a number of classes of mine. Give me any area you can forecast with reasonable commercial accuracy. So, I'm not saying 100% exactly, but I'm saying something where you can put an investment or make a decision which will return you a profit. And really, none of them come up with much, And things that are clearly measurable, things like sporting events and political outcomes and, events that you actually know what the exact outcome will be, they're basically unpredictable. After every election in every country, the pollsters all wander around, how do we get it so wrong? And not always, that's not fair.
Okay, so in relation to finance and economics, you mentioned the invisible hand. I guess that would be a example of sort of the dark matter plug for that theory or that reason. Yeah, and it's kind of, I really enjoyed that analogy when you really start to understand how difficult the things is to really explain. And you also go into you mentioned behavioral finance as well as another one, I guess, to fill in the gaps of sort of neoclassical normative theories that try to explain finance and economics as well. But you're also a bit critic about behavioral finance. So what do you think is the main problems with the behavioral finance as a discipline?
Not about discredit, but the behavioral finance is very good at giving explanations of what's happened. And a good example is if you think about a share that goes up in price and it goes up and then other shares will go down. And there's a pattern where people tend to hang on to the winners and avoid selling the losers. And that has a couple of different explanations. My favourite is mean reversion. So if you've got a share that goes up and one that goes down, all else being the same, the one that's gone down will go back up. So you wouldn't sell the one that's fallen because you think that'll go on, and you take your profit on the one that's gone up.
Right.
And then there's another one that says you never want to go home and tell your partner or kids or parents, I lost money on a stock today. So you have what's called loss aversion, and you don't sell losers because you don't want to crystallize a loss. So you've got two situations, one situation where investors don't sell losers, and it's got two totally different explanations. And behavioural finance has lots of explanations, often more than one explanation for exactly the same evidence, but it doesn't really tell you much more than be aware of these potential biases in your thinking or other investors' thinking. It doesn't actually say go out and buy this particular stock. And in fact, there's been a number of mutual funds that have been set up, which are trading on behavioural finance sort of theory and understanding and so on. And they've all performed abysmally, lost huge amounts of money. So it's a very interesting explanation. It's very good cautions for investors to be aware of these possible biases in them, but it doesn't actually give you any advice about investing or doing anything positive. So I guess that's why I don't find it a very satisfactory explanation.
Right. Okay. And so do you think one of those reasons, because you referred to markets as a complex closed loop system.
Yeah.
And you use this analogy of football or soccer. So do you think that's one of the reasons why it's so difficult to actually make any kind of predictions? And how would you define a complex closed loop system?
Yeah, I'm not saying this task is easy. It's funny, in my career, I've been on the investment side of retirement savings accounts. So I've been a trustee of it, and I've been a manager of funds that manage retirement savings. So I've been on both sides of the thing.
Right.
And whichever way you look at it, it's extremely hard to invest money. It's just not an easy task, and nor is predicting earthquakes or anything else for that matter. So I think they're fundamentally very difficult tasks. And one of the reasons I think they're difficult is you mentioned the football analogy, and if you think about a machine that fires out footballs into a team of players, and that's a common form of training in a lot of clubs, at least out here. So the machine is there, you know exactly where it's going to be fired, how fast and everything like that. But you've got no idea where the ball's going to finish up because you've got how many players are hanging around. It could be the full 22 or not. But as soon as one of them moves, another one starts moving. They may or may not make contact with the ball. And you've got all these feedbacks occurring in response to players hitting the ball or missing the ball or hitting each other. And it's really, although you know exactly where the ball is going at exactly what velocity, you've really got no realistic chance of forecasting whereabouts it will finish up on the field or in one of the goals or anything like that. And I think markets are like that too. You know, if you're sitting down looking at the stock market and Mr. Trump says something about the Federal Reserve Chairman, or Warren Buffett retires or doesn't retire, and all these things can happen. And it's not just what they do, it's what other people do in response to that. It's how other investors react. You know, does BlackRock put out a press release? So you've got all these feedbacks and loops and changes and things like that. And it's not just a question of working out what the next 12-month sales will be for a company. You've got all these overlays. It's extremely difficult. So that's what I think of as a complex system. It's got many, many moving parts. You know, it's sort of interesting in finance. Around the world, finance is taught in a finance department, and that's sort of isolated, not just from the rest of the world, but from economics. And yet we know with things like the price of a stock, it's not just markets behaviour, but it's politics, it's geopolitics, it's what Mr. Xi's doing, you know, what the Chinese have decided. It's what's happened to oil prices. So there are all these factors that are running together, and it's an extremely complex business to see what's going on.
Right. Yeah. And why would it be a closed loop system? What is the definition? Or why is it not an open loop system? Just so I understand that.
An open loop system is a bit like the solar system, that there are no constraints on it. It's totally open to the outside. So planets can move around. At the moment, for instance, there's an interstellar object passing through the solar system. It's literally going from one side to the other. So that's an open loop system. A closed loop system is when things are contained. So the soccer ball will bounce off players' hands. It'll get caught in the net. It'll bounce off the ground. So it gets moving around. Players will then move in to intercept it. So the ball is not free to move and pass on. It's becoming influenced. And that's the same with equity prices. If you think about the difference between a horse race, for instance, once the horses are started, they continue to the finish, and there's essentially not a lot of interference. But that's not true of a stock, where literally the information flow in an informed market is enormous. It's huge amounts of information and what people are doing, and there's information that doesn't flow, private information. So all this stuff, knowledge and interpretation, data, reports and activities by people is impacting on the closed system, and there are feedbacks that are coming from that. So it's quite a different system. The big difference is we're able to pretty well predict open systems like the solar system, but we can't predict closed systems. There's just too many changes, too many things that can feed back and alter the future, so we can't predict it.
And okay, so why do you think that finance theory is so bad when confronted with the real world? If we just try to focus on, the modern portfolio theory, as you mentioned in the book, for instance, or the capital asset pricing model, which you find interesting that we still teach finance students, for instance. What can we say?
Yeah, okay. The capital asset pricing model and a number of other things, the discounted cash flow valuation of any financial asset, for instance, these are pretty standard tools of interpretation and analysis in finance, and they have their parallels in many other disciplines. What they all do is they assume that the system is in equilibrium. They assume the system can be or is governed by a small number of mostly linear laws, and they assume all the data is available. So to me, none of those are true. Finance decisions are basically made in private, secret, whatever you like. People don't release the data they rely on to make the decision. And I know from my own experience talking to fund managers, often the last thing they do is get out a spreadsheet or a calculator. They sit there and they'll work out, do I like this particular investment opportunity? Do I like this particular market or country or type of asset class? And then they look at the best in class. They look at the business model. They look at the management. They look at the past performance, because nobody wants to buy a stock that's had shocks and surprises in the past. So stocks that notionally look quite good can simply be rubbed out by fund managers because of past history. And then it's only at the end that they sit down and have to write a financial report. So what's happening actually in the marketplace or in the real world, in the financial world, is that fund managers are not using numbers to make financial decisions. They're using all sorts of other more qualitative tools. And yet in finance theory, we teach these quantitative tools, and there's no real matching of the two. That was what I found.
That's surprising, I would think, for most who's not read up on this qualitative capital market research. And why are we not able to produce theory that is aligned with the practice? What's the issue here?
Well, I think one thing is data. So we simply don't have the data on what people are doing. If you think about the academic papers that look at say, the capital asset pricing model, they use a huge amount of information, basically drawn from financial markets, and they analyse that. But most of the decisions are taken in private, as I said, so you can't work out why the decision was taken. It is possible to draw some conclusions from remote data, But if the fund managers aren't using things like earnings flows and discount rates and things like that to make the decision, there's no point in having that information because it's not telling you why the decision was made. So I think it's fundamentally difficult to work out why fund managers are making decisions using remote data, because you simply don't have access to what's going on in the offices and the bullpens of the fund managers. So it's coming back to this using data you have, which is prices and valuations and so on, which fund managers don't rely on very much. It's believing in a few simple laws that govern security prices, and fund managers don't believe that. They look for relative advantage, competitive advantage between choices of stocks. So the average fund manager, looking at a modern equity market, they will take the index and they'll adjust around the index. So there's a lot of pressure on fund managers to stay reasonably close to the index. So it's more overweights and underweights rather than particular stocks that they're involved in. So it's what the academics are looking at and analysing is not what the investment managers are doing. So it's very difficult to work out what they're doing if you're not using the same data and have the same information they have.
Right. Okay. So the current finance paradigm, the theory, fails to properly sort of explain what finance practice does. So could you say that, so the theory is wrong, or is it that sort of from the academic side that finance practitioners are not using the theory correctly? Where do we stand there? So I guess some academics would say, well, people are not rational. They should be doing this instead. They should follow, this way of doing things. Instead, they do a lot of things which are not aligned in theory, and hence they make bad decisions. I mean, for instance, as you mentioned, active fund managers want to stay close to index, but we, study after study showed active funds underperform index funds. So could we take that as evidence that the fund managers have a lack of predictability, lack of valuing, lack of truly overperforming in just relation to index investing?
Yeah, I think there's a couple of questions in there, and one of them is what academics are doing, and they're based on my observation and reading and so on. Very few finance academics and texts are looking at predicting winning stocks. They tend to look a lot more at construction of portfolios. They do a lot more about explanation of past performance, analysis of risk, and things like that. And the principal factor of interest for most investors is which stock is going to outperform, and we tend not to teach that in finance classes. So you've sort of got them moving in parallel. Academics are looking at one set of questions and practitioners are looking at another set of questions, and there isn't a lot of overlap between them. So an undergraduate or graduate finance course is very useful background, but it doesn't actually help you to start picking winning stocks on day one. And most of the big banks will have an in-house university equivalent, and they spend a lot of their trainees off on 6 to 12 months in-house training to get them up to speed in areas that they want. So it's, I think that the big banks appreciate what the universities are doing, but they don't see it as providing them with job-ready graduates.
Right. Okay. So why don't we simply just teach what the big banks teach? What's the issue there?
I don't have a good answer to that. I think it's like a lot of this. My original undergraduate degree was in engineering, and I spent 4 years at university and got a very good education. And when I got to work on the first day at the mines in Africa, I was absolutely useless and sent off to 6 months training by them. So yeah. I don't think it's confined to just finance. I think universities provide a very good regimented way of thinking. The better ones provide you with an excellent framework to draw on. But it's not, we have a thing called trade schools in Australia. They're not, universities don't see themselves as a trade school. Right. And I don't think they have any intention of providing job-ready graduates. being realistic about it as well, very few graduates stay in the same job for their whole life, so they move on. And in fact, after 10 or 20 years, it's much better to have a general qualification, a knowledge of thinking, good, rich, deep education background, and a lot of confidence in being able to do research and think for yourself, rather than having any specifics about what might be useful for the first few months at work.
Yeah, right, of course. But okay, so what if I ask you this, like, what should we be doing then if we don't really understand how, like, the current finance valuation theories are not working? So what can we do to approach the valuation of equities in a better way? Is there a better way?
Yeah, I think we need to change it. And what you've been reading, the last book and the last couple of papers I've written have been looking at applying a much more cross-disciplinary approach to research. That I think and I'm not just saying finance, this is most disciplines, it's too siloed. You walk onto a university campus and there's a building which is the economics or commerce or whatever, and then on different floors they silo economics and finance and accounting, and yet all these topics are very multidisciplinary. One of the interesting things about behavioural finance, I know at Melbourne University, where I'm based, there's multidisciplinary teams there working on what's basic decision theory, and they use a lot of finance decisions because they're easy. But there'll be doctors there with MRIs, and there'll be psychologists there. And there's all sorts of people working side by side in a team. And I think that's a good start. These questions are not finance or medical or psychological questions. They're genuinely multidisciplinary. And the more we can do that, I think the second thing is, one of the things I notice at university is there are very few performance measures. And in industry, broader community, you've got things like GDP, you've got things like profit. And research doesn't have any performance yardsticks. No one's getting rewards for being able to predict something. No one's getting rewards for forming companies. So I think one of the things would be to basically split research into theoretical and practical, or applied, and move all the applied and practical out of universities and into research institutes. Many places, one of the ones I like most is driving in from Washington, D.C. along the Dulles airport, and there's a corridor there for about 50 or 100 kilometres that's just wall-to-wall industry and technology park. And if you can locate in the middle of that, you've got a bit of a chance of getting linked up and getting much more multidisciplinary, and also much more focused on performance as well.
Yeah. Okay. So the multidisciplinary is a important part of your idea for a solution. Right.
Rubbing it up against the real world and putting in place performance measures that you've got to demonstrate the value of your research, commercial value. I don't mean just wonderful ideas and things like that. And there's a bit of a sense of in academia that good ideas have their own benefit, and I don't think that's true. I think you need to be able to demonstrate a significant commercial benefit for a significant portion of the research. Again, many countries are spending tens, hundreds of billions, trillions of dollars on research, and we should be getting a payback for it.
Right, and as you say, right now we're not getting, we don't know enough, and we are not able to predict the future. So the future is full of risk, as you say. And why is that bad? Why can we not just go on as we've always had, so to speak?
Well, we can. If you look at finance more broadly, it really has three techniques: the banks apply and investors apply. And one of them is diversification. The old, don't put your eggs in the one basket, and that's still a very, very sensible strategy. Second one is to manage risk with its broader sense of not just variation, but uncertainty, lack of knowledge. Areas that aren't well researched are dangerous because you don't know what's in there. And the third one is counterparty risk, that despite all the talk we have about losing money from investment decisions and things like that, the major cause of bank failures and bankruptcies and so on is counterparty risk, that we give somebody our money and we don't get it back. And again, you can go through a 3 or 4 year undergraduate degree in finance and no one will talk to you much at all about credit control or counterparty risk or bankruptcy. It's taken as something that doesn't occur in nice, well-run markets. Well, I'm sorry, it does.
Yeah,
Every 5 to 10 years, we have a raft of bankruptcies around the world.
that's true. I wanted to touch upon some of the principles, the 10 principles of equity investments, which 3 of them at least I found really interesting. But start with 2 of them. The first one I've noticed, which is number 7. The most reliable forecasting technique is naive extrapolating of recent data. I mean, if you grow up learning all the techniques there is, and you think you're able to forecast based on a lot of different things, you use the models there is, but then coming across something like this, it's just extrapolating recent data. You sort of make it very sort of, this is the thing that you can do.
Yeah, well, it's sort of strange. If you go into practitioners area, the fund managers and large investors and so on, they're just behaving quite differently to what is explained to you at university. And I didn't find that unsurprising because I came from the other direction. So, I'd worked for a couple of the largest companies in the world in their corporate treasury and their planning department. So I saw how they made decisions, and I'd sat in sort of boardrooms where executive directors sat, just 4 fat old guys with cigars making a decision for several $1 billion worth of investment. And I saw how they did it. And the only reason I was sitting there was they wanted me to go back and do all the clever fancy spreadsheets and board papers and things like that, putting all the numbers in there. But there wasn't even a calculator in sight, much less a spreadsheet or a computer. So that's not how they make the decisions. And my shock came from coming out of that environment and going to university, because I hadn't done an undergraduate finance degree. So I hadn't got all the theory, and I'd come the other way from engineering and then up through a corporate background. But it's when you grow up in the finance environment and then go into the real world that there's exactly the same shock for the same reason. It's just a different kind of shock.
Right. And you also say that no more than about 10% of future equity returns can be predicted. That to me would also be, I believe most people would be surprised if you're working with trying to predict future equity returns. That's your job, and someone says you can only do about 10%. Wouldn't that?
You've made the point a couple of times, and I haven't bitten, but the idea that active investment loses money and passive strategy of following the index is often the most successful, and I think that's true. I don't want to get bogged down in the detail. There are some complications with that calculation, but essentially it's correct. It's extremely difficult to beat the market, and if you can't beat the market, then it says no one. Well, if no one can beat the market successfully, and even when you look at people who do, so Warren Buffett's a classic example, but Peter Lynch of a previous generation. So he ran a fund called Magellan for Fidelity in the US, and one of the things that Lynch did, he wrote a really interesting book called One Up on Wall Street, and for a long time he was one of the most successful investors, like Buffett was. And Peter Lynch used to talk about he'd be at the supermarket or he'd be filling up his car with petrol, and he'd see somebody with a new model in the bay over. So he'd go over and talk to the driver, how do you like it? What was the buying experience? And, are any of your friends buying it? And within about 10 or 15 minutes, he'd have a full portfolio analysing, it might have been Ford or GM or whatever it was, looking at their new car range. And he, of course, was a value investor looking at strong returns, well-priced stocks, and that was a period when value was king, and he made a lot of money on that. And Buffett was a bit the same. He was very much a value investor. Buffett famously wouldn't get involved in cryptocurrency and things he didn't understand. But that was value investing at a time when the share market was discounting earnings and insisting on every tough dollar. So these are people who had a style which matched the times and were very successful. And if you've got that, good luck to you. But unless you can do that, you're much better off just buying the index, not shooting the lights out, but not losing your shirt either.
Right. Okay. So why do you think sort of active fund management still persists, even though there's so much evidence that they're not really able to outperform the index funds.
Behavioral finance. We all have a dream we're going to be rich and retire down the beach or something like that.
So it's the option that if you invest in an active fund, you can always make more money than the index, and you don't really think about that you can lose more.
No, and I've worked for some of those active managers.
Yeah.
Some of them do have evidence to back it up, and there are periods of time when funds like Buffett's and Peter Lynch do extremely well because the times do suit them. But I think on average, I don't know about for you, but in Australia there are more listed funds or more registered investment funds now than companies that are listed on the stock exchange. So it's actually harder to pick a good fund than it is to pick a good stock. And that's not an easy thing either. So, whatever you do, it's extremely difficult to pick a winner. And unless you've got some innate skills, how can you do that?
Right.
For sure there'll be 10% of funds that will significantly outperform the index this year. But for which 200 of those funds? I've got no real way of telling. And if you look at the academic research, they tend to move in and out of at least the top couple of quartiles. So the winners this quartile or this year probably won't be the winners next year. So how do you actually identify a good performing fund? So even if you believe in active management, it's not easy to put it into practice.
Right. And another thing you talk about, which I think is interesting to bring up or important to talk about, is the fact that to make any sort of reasonable forecast about stock return or a company's profits, or not sure how exactly what parameter you use to define it, but you talk about a 1-year horizon is a fair holding period, I guess. And if you look at the average holding period, it's usually 1 year, right? People sell everything in a year, 100% turnover, right?
Well, that means some people are turning over a lot more than once a year, yeah.
Yeah, but I thought it was interesting that if there's that obviously for different investors the holding period will be different, but on average, if we make the assumption now that the holding period is a year, and then see the alignment between the holding period and the ability to forecast in 1 year's time. I'm trying to make that connection. Is there one, or are they unrelated?
I'm not really sure they're related. A part of active management is you do need to keep readjusting your holdings, and then there are a small number of very active investors. The other thing, there can be some artificial increase in apparent turnover with some of the off-market pools that are working, where a lot of large mutual funds, investment funds, will cross parcels between themselves. So they apparently are changing hands, but they tend to be more being rebalanced within groups of portfolios rather than anything else. But yeah, the turnover is very high, and I don't think there's any. So what you've got to do is you'll find that there'll be a relatively small number, maybe a third or a quarter, that is turning over several times a year. That's how you get the turnover up. But what their accuracy is, I don't know.
Right. Okay. Can we maybe go back to the research in crisis? Because there's one thing I would like to ask you about. So if the current sort of scientific method, observe, hypothesize, test, is ill suited to what you mentioned, what you named the dynamic closed loop systems like markets, should we find a different way in trying to understand markets? And if so, what kind of alternative do you suggest?
Yeah, I think there's a broader question than that is, and so far we've talked a bit about how you might improve understanding, and I think by setting research into a better environment, a more productive environment, and with more performance indicators, it certainly won't hurt it. But I think it's a long time before we're going to really have a good understanding of much of these systems. And I don't care whether it's markets or any one of the other systems we talked about, especially the most damaging natural disasters. And I think what we do now with natural disasters is we basically try and protect against their damage. So if you're worried about storm surge or you're worried about flooding, then you'll put in place physical protections. And I think we need to be thinking a lot more about that rather than being able to fine tune the future and understand it. We need to look at a different style of decision making. So we need to look at decisions that have much more options in them. So we're not looking at particular point forecasts. We're looking at a range of outcomes. We're looking at sort of managing the fallout of things that we can't maintain. And that's the same with a portfolio. If you've got a retirement portfolio, I think you're quite silly to have a concentrated portfolio. You should have a much more diversified approach. And there's a sort of interesting approach where, depending on people's age or years to retirement or something, they change their investment strategy. They become much more risk neutral or risk averse. And you can't stop taking risk, but risk that you might have taken at the age of 20 or 30 with a smaller portfolio, you don't want to be taking at 50 or 60 with a much larger retirement portfolio. So I think certainly it would be nice to improve research productivity to better understand these complex systems. But I think there needs to be a lot more humility about it, that we are a long way away from really understanding that. And we need to be a lot more careful about how we manage the risks associated with these things and protect ourselves from damage.
Right. Yeah. Okay. So I have one final question for you, Les. And knowing what you know today, and if you were to start doing a PhD in investment, trying to build on investment theory or change investment theory, how would you go about doing that?
I'd probably go and work in one of the middle-sized American firms. So there's a number around that have an extremely active research portfolio. So when Ken Farmer and French got their Farmer got his Nobel and French got a lot of accolades, they were picked up by a couple of funds and really formed the core of some very powerful investment teams. And to me, that's the way to do it. That's how pharmaceutical companies, for instance, research blockbuster drugs. They don't do it at universities. They have their own research laboratories, and same thing with a lot of chemical companies. And so there's quite a number of industries where the practice is that the leading companies will have very large research facilities. So you've got globally leading researchers who are embedded with the most skilled manufacturing and research people you can find. So I think I'd find one of those to literally be right next door to a trading room where I was doing my research. And it was funny. It's not really funny, but it sort of made an impact on me. And we had a presentation at university once, and there's a very senior guy came from Houston in Texas, and he was talking about a new model on oil prices. And the discussions came at the end, and I said, well, you're based in Texas, in Houston, the world's capital of oil. Have you been and bounced this idea off any of your peers in the oil industry? And knowing myself that it's easy to ring up one, and I said no, I didn't think they'd be able to add any value. And I always thought that was strange, that you didn't see any value to be added by people who are most knowledgeable about the practice of the market. And he got to a stage where he'd done a lot of very clever work, and he could have just made it that much, well, I would have thought better, but different, had a different perspective on it by going and bouncing it off somebody else. So that's what I like to do every day. Morning tea, lunch, be in a situation where I'd meet traders, I'd meet the big fund managers, I'd meet the sort of people coming from big companies selling their stocks to the fund, and bounce my ideas off them and draw on theirs too. A proper interchange of ideas two ways. And I think that to me is the only way we're going to improve finance or any of these other complex systems in terms of theory and understanding.
Well, I think that's a really neat way to see it, because I usually find, even though I haven't even started yet, but my sense is that, as you've said, universities are very sort of siloed, and they like to sit in their offices and think about things and not really go out there. And obviously it's different between disciplines, but that feels a great way to improve it is obviously more contact with the real world in every sense, both meeting the people who make the decisions, but testing, I guess, the theories to make sure that they stand up against the real world data, as you argue for.
It's a lot more fun, a lot more money too.
Yeah, exactly. Well, Les, thank you very much for this conversation. I really enjoyed speaking with you, and I hope I will definitely follow your research going forward, if there's, because you're still active, right?
Yeah, and I've got a couple of papers under review at the moment.
Oh, nice. Awesome. That's great. Look forward to reading those. Are they up on SSRN, the working papers?
No, they're a bit controversial. So
Okay.
I've become interested in public policy the last 5 years or so, and so that's what I've been publishing on. So no, I've tended not to put them up as preprints.
Right. Okay. Yeah, understand. Well, I will make sure to read them when they are published.
Okay. Well, you follow me. I'll put it up on LinkedIn, so you'll be able to see it there anyhow, Johan.
That's great. Okay. Well, thank you very much, Les. Enjoy your afternoon, and hope we can stay in touch after this.
Okay, that sounds great.